Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 6, 2018. In this video, I wanted to go over all the trade ideas, the long side trade ideas right now. There aren't a lot out there, and I'll talk on that as well. And also touch on again the benefits of asset allocation. If you're new to the site, that's something that I've talked about in the past, and I try to maintain on the trade ideas on the site, some type of balance between various asset classes. Again, I did a video recently. If you're new to the site and you want to take a look at that video, just drop me a line in the trading room or from the comment form, and I'll send you a link to that video. But it goes over the benefits of asset allocation and how one can actually increase their returns overall while actually lowering their risk at the same time by including various asset classes. And those asset classes are, well, we're looking at some of them here: stocks, bonds, cash, commodities, precious metals. Those are all different asset classes. So what we're going to do today is update the trade ideas. And before we do that, just talk on something that I've stated quite a bit recently. The trade ideas have never been so light on the site for so long, such an extended period of time, and that is directly a function of the opportunities out there in the market right now. So this is an article here in the Wall Street Journal. And if you subscribe to the journal, you'll notice they now pop up. They've done this for a little while now. Even though you're paying for a subscription, they still hit you with advertisements. Crazy. It shows you how I guess news has become a commodity in this technological age with the so much out there on the internet and Twitter, everywhere else. But here's what I wanted to cover. All right, so this article came out on Wednesday. So if you recall, or no, I'm sorry, Tuesday. So if you recall, the market had that big pop up on Monday and then gave back a lot of those gains on Tuesday. So this is as of the close Tuesday. And as you can see here, it's basically said what I've been saying for a long time. Cash right now is one of the best positions. Most people don't consider cash as a position. Everyone's, and all the questions I always get: Randy, where can I make money? What's the next trade? Where's the best place to put money right now? And 99.999% of the time, there's something out there. And of course, we do have a few trade ideas. Again, I'll go over those. But for the most part, this is a very rare instance where we're seeing just about all asset classes falling. Keep in mind, so they're showing you the year-to-date returns, and again, as of Tuesday's close. Remember, the S&P 500 had a big day on Monday, dropped on Tuesday, had a big down day, but again, it's down about 2.5% right now. So as you can see here, we were at just over 2.5% return on the S&P 500. Take that away. So now cash is king as of right now, according to this article. And of course, this is year to date. Now, this is just a snapshot as of Tuesday's close. Remember, the S&P 500 was up for the year. Some other things were doing well, but in the recent months, we've seen just a broad-based sell-off. And again, it's something that I predicted going forward. This is what I call, or what I attribute to at least, popping of a credit bubble and a margin bubble. And when that unwinds, everything gets sold. That's just the nature of a credit bubble popping. So everyone was looking, where's the next bubble in the stock market? Where's the next bubble in the stock market? Well, the bubble was a credit bubble blown by the Fed over years and years, and all the central banks of extremely low interest rates and an extreme amount of money supply, injected into the economy with quantitative easing. Or into the financial system, I should say. So there it is. So cash is king. And I know it's frustrating. Everyone, especially when you're new to trading and you have a few hits, you want more. You want more. You want the next big hit. I manage my own money and I try to manage the site for maximum profits. So whether you're a long-term investor or even an active trader, a swing trader, this comes into play as well. And again, we know, don't get me wrong, we've had shorts, so we've been able to profit on the give back in the S&P. And we can short many times. If you follow the site for a while, you can go into the archives under completed trades, go back for years, and you can see a lot of shorts on gold, or more importantly, I usually use the gold stocks, gold mining stocks, bonds. I'll go over that in a second here. There are times where you don't want to be in certain bonds, and but again, I just wanted to point out. So as you can see here on the scale, Here's the mark of zero returns, and these are all negative returns right here. And as you can see, and I've made this clear too, although I was bullish on bonds, at least in recent weeks, recent months, when the stock market finally started to turn, I stated I don't like investment grade bonds. Normally, people think of investment grade bonds. Some of those are AAA rated, just like government bonds, AA. I'll go over the rating scale in a second. And most people think of those, oh, okay, well, they're nearly as safe as treasuries. The problem with investment grade bonds, and let's jump into that now. Let me see, I have another chart I want to show you. Here we go. This is off Fidelity's website. I just did a quick Google search. You can find this if you Google bond ratings. These are the rating scales. Now it gets a little confusing to some because they're primarily three different agencies that have rating scales. Now they all agree AAA is their best, but then it goes down to, Moody's AA1, whereas Standard & Poor's their designation along with Fitch is AA plus. But here's the thing. All you have to remember are the letters really. Anything triple B or above. So you see the scale AAA being the highest, goes down the scale. Triple B or above is considered an investment grade bond. And what that means is pretty much chances are you'll get your money back, that company is not going to go into default at least for the foreseeable future. The safe money bonds or secure companies with strong balance sheets, etc. Then when they drop down below the triple B rating. So again, Moody's kind of mucks things up a little here with their ratings. So let's just stick with double B or lower. These are what they call non-investment grades, but you probably know them better by the term junk bonds. Junk bonds, that doesn't mean go throw it in the garbage because they're worthless. No, it just means the company's balance sheet, their financial situation is a bit precarious. Of course, as you go down the scale here, it gets even worse. And so you run the risk that if business conditions worsen or something happens with that particular company, they could default on the payments. And that means you'd stop paying interest. And it is even possible that you don't get back some or even all of your principal on those bonds. Ultimately, if a company goes into bankruptcy, creditors stand in line, bondholders are creditors, they'll get paid off if there's enough money there. So I don't want to go into the details too much, but here's what's going on in the bond market. And this is why I said recently stay away from investment grade. In recent years, the bulk of the issuance, there's been a tremendous amount of issuance on investment grade bonds in this triple B rating scale. So a lot of the companies that were triple B went out, got a tremendous amount of debt with pretty much free money from the Fed recently. And the problem there is when you are right there on the edge of triple B's, once the economy starts to turn down, and this ship is turning, I view the economy just like a giant super tanker out in the ocean. That thing's not going to turn on a dime. It takes a long time for a tanker, an ocean liner to turn or a super tanker. But that's what's going on with the economy now. It's clearly starting to turn. And what will happen is more and more of these companies that are triple B will get notched down. They have their ratings um, knocked down into the arena of double B or even lower. So okay, big deal. So they got knocked down one rating. It actually is a big deal because, first of all, now there are a tremendous amount of bond funds. The bond market's bigger than the stock market, dollar-wise. There's more money in bonds than there is on all the stocks added up. So it's very important to the economy. This is what pension plans have. They don't put all their money in stocks. They have to diversify. And there's a lot of bond funds. You probably have some in your 401k. Now, what happens there is a bond fund runs off a directive that says what they can and cannot hold. And so if you want to put your 401k in safe money, you're going to put it in an investment grade bond fund or government bonds only. And what happens is those investment grade bond funds have to sell. Once those bonds, they had a big chunk, they had a lot of money here. Why? Because the yields are a lot higher the lower you go down. This is all works, risk and reward go hand in hand. As you go down this rating spectrum here, the returns or the rate that those bonds pay goes up. They have to. You're going to demand a higher payment as an investor for taking more risk. So this is where the investment grade bond funds were chock full of these bonds. But guess what? They get knocked down. Number one, when they get knocked down, even before they do, the street sees it coming. Wall Street is pretty efficient at pricing in risk. And so when they see the likelihood of the downgrades, which is, looking at the economy starting to slow, the bonds instantly get priced down even before they're downgraded. Once they're downgraded, they'll even go down more. And so what happened is these investment grade bond funds, they lost money before they even had to sell them. Then they had to sell them once they were no longer investment grade. So they get knocked down to here. And that's why we've seen the biggest drop, because one might say, well, wow, the economy's really, or the stock market's slowing down quick, indicating a slowdown here. But let me show you one other thing here. Okay, going back to this, again, that's why the investment grade bonds, in my opinion, were the worst, because we've seen a big drop off recently. We'll get to the charts here in a second. So again, what we're doing is asset allocation. We're positive. We're positive on all our trades here. We're positive on, we have Treasury bonds. We avoided investment grade bonds. We avoided, we're the only, most of the official trade ideas recently have been short stocks. So we've profited on the drop on stocks. We've profited on treasury bonds, we've profited on gold, and everything else is down. We avoid, and cash. I've told a lot of people recently, hey, it's not a bad time to put a good chunk. And depending on who you are, if you're risk adverse and you're at the site, you're not an active trader, you're just an investor looking for some guidance. There's nothing wrong with cash. A lot of people just have that mindset where they have to make money. But I say there are periods of time where almost everything goes down, and it's better to not lose. You're actually getting ahead. If everybody else is dropping 20, 30% on their investment, that's deflationary, and you're getting ahead if you can lock in your gains in cash, 401k, whatever it is. Because I know 401k money you can't short, and a lot of investors don't like to short. All right, let's get off this and let's take a look at these individual trade ideas. Okay, let's start with government bonds, and this is the proxy I'm using right now as the official trade idea, and have been. I have to revisit where exactly we bought into this one. I don't have the entry price on here. You can check that under the trade ideas on the main menu on the site. But we're almost to the second target now, so we hit that first target the other day, and a nice move on Tuesday, and nice follow through so far today. We're just shy so far. We hit a high of 1920 versus a first target of 119.20 versus a second target of 119.25. So we're not far from it. Somebody asked today in the trading room, what about TLT? Well, that is resistance. It's not the most solid resistance level. This one's a lot more significant, and that is why this is the final target at this point in time, and probably will remain the final target if we really see a considerable drop in rates. Longer term, we may work our way up here to TLT, about that 127.34, but this is the final target unless I specify, revising this. I'll be closing this trade if and when T3 is hit. And the nice thing about TLT is you get paid to wait. We've been in this one now. We've collected 2 dividends so far, and even if it trades sideways for a while here, which it might, let's just take a look at the charts and I'll show you what I'm seeing. All right, so you could see that downtrend line on the daily chart we were just on. This is a weekly chart, so this is 10 years, 10 years of price history. Here's a downtrend line right there, and we're at that, coming up to the downtrend line now. We're not far from it. So that target's set a little bit below that level. And chances are we will consolidate or pause around that level when we hit that. That's a pretty significant multi-year trend line right there. Bigger picture, it looks to me like this, and this is, what was the whole premise for the trade. We bought it somewhere not far off there. There was a divergent low. So this is a big, big bullish divergence down below on the PPO, on the RSI, just like we had here, negative divergence. And this is, this is a swing trader, or more even a trend trader time frame. When I come out to the weekly charts and I see these multi-year divergent highs or lows that last for took months or even years to build, that sets up nice swing trades that can last for months or even years. So we'll call these trend trades. So that was the initial leg down, but that's really how much we've dropped from that divergent high. So we've come for full circle. This is a big, powerful divergent low. And, long before Treasury started to rally here, a couple months back, I started to become bullish on the Treasuries. And I said my reasoning was, I expected a significant top correction in the stock market in the fourth quarter, and that was right at the highs in the market. We got that, and there may be more coming. And because of that, I said that would then turn down future economic expectations. Everybody, and that's just the nature of the beast. The analysts are foaming at the mouth, bullish at the market highs, market top, thinking that the good times will last forever. 10 years into one of the longest economic expansions in history. I don't know how these guys keep their jobs, but anyways, so economic outlook was super bullish 2 months ago, and now it's sharply been revising downwards. That's what's going on here. So two things are happening with treasuries, and that's why we got into this. We're finally getting that flight to safety bid because there's nowhere else to hide. I knew it would happen sooner or later. It was a matter of time. The treasuries were dropping in line with stocks earlier, starting after the correction. And the other thing is, I also knew we'd get, if my, of course, if I was right on the stock market going to where it was or is, that economic expectations would then be tempered down. The dot plot to the Fed rate hikes, the trajectory of the expected rate hikes would drop. We're seeing that now. Everything that I talked about 2 months ago is happening. The Fed's backing off their hawkish stance, backpedaling, softening up, becoming more dovish, and as they should be, because like I said, the whole thing, it's pretty simple. Stocks drop, consumer confidence drops. Consumer confidence drops, consumer spending drops. Consumer spending is 70 or so percent, or 2/3 roughly of GDP. Simple. So there it is. So now we have to let's figure out where we're going from here. So there's a weekly chart. Could we break out and just keep going? Yes, but we're pretty extended. When you get a run from a bottom of a wedge like this is a large wedge, by the way, the yellow. From the bottom of the top, usually you expended a lot of energy to get there, and you're going to consolidate first or pull back and then break out. Is it possible to keep on going? Certainly is. Big meltdown in the market. If we don't stabilize soon, like I said, I think at most maybe another 5-6% downside in the market, maybe not even that much. So if the market rallies soon, hits bottom, and puts a multi-week or even a multi-month rally, and we'll probably pull back here, and then this breakout will be for a later date, so we'll watch that. And there's a target level up there. So that's weekly chart. And let's just take a look at a few other things before we move off of this. The inverse to TLT. TLT holds government treasury bonds, 20 to 30-year treasury bonds. And so what affects those bonds are the rates on the bonds. And this is TYX. This is the 30-year treasury yield, so the rate that the bonds are paying. This chart will be a perfect mirror image of TLT because when rates go up, bonds go down, bond prices go down, and vice versa. So while we had a bullish falling wedge on TLT, we have a bearish rising wedge, which only makes sense. Again, it perfectly mirrors the other wedge inversely, of course, on TLT. And there it is. So there's rates down at support. So you want to look at it this way. You have long-term rates, 30-year treasury bond rates at trendline support now. However, it's these divergences in place that tell me that whether or not we get a bounce here soon and another thrust up in the wedge, sooner or later this wedge breaks down and rates are probably coming down more, and that'll be bullish for bonds. That'll give us that last thrust up and hopefully hit our third target and final target, get out of there. And again, there's a potential for a lot more. If things get really ugly, and you could see rates come all the way down here, back at that 26.66 level again. And then let's not forget the very long-term picture. This is important. This is a 30 plus year, 35 plus years. This goes back to the 1970s. This is when rates peaked. That was the high. If you're old enough to remember, that's when rates peaked. 1981, Reagan was president, and we had double-digit, huge rates. And so we've been in a secular bear market in interest rates for decades now. And this is an important trend line to watch. There are big divergences building. Sooner or later, we will break out of this range, and then rates will go up and treasury bonds will fall. So right now, it's more of a tactical trade that I'm looking at. But longer term, we'll keep an eye on this one. But interesting to note that we had rates run up and hit that trend line, and then they reversed. So there were a lot of factors. And I said that before we did the TLT trade, and at the time, that this trade was based, I made both a fundamental case, which I made a minute ago about the stock market dropping, consumer sentiment going down, and spending going down, as well as a technical case, meaning technical analysis. And so some of the best trades are where you can line up both the fundamentals and the technicals, and that's what we did with the TLT trade. So that's where I think it's going. And if you want to look at a couple other things real quick, this is that's the 30-year bond. Here's the 10-year bond, TNX. TNX is the 10-year bond yield. And you can see it also had a nice run up, very overbought to get to that level, very extended, and ran into resistance. So it was natural to expect rates to pull back, despite the fact 2 months ago everybody said rates were going to the moon and everybody was, bullish on rates, bearish on bonds, and that's when I like to step in and buy when no one else wants them. So that's TNX. There's a monthly chart. And then I won't go into too many. We could look at the 5-year bond too. There's the FVX, which is a 5-year Treasury yield. Also ran into price resistance there. Okay, here's LQD. This is a corporate bond ETF. So remember early on I showed you how corporate bonds were the worst performing class, and you can see it here in the charts. This is here January. Here's where we started the year right here. Everybody was cheerful and optimistic, thinking the market was going to the moon. No more corrections were a thing of the past, that the Fed had abolished any future corrections or the possibility of any corrections because the Fed had the markets back or whatever reason was being attributed to. But that you can see that corporate bonds have just taken it on the chin. And again, these are investment grade corporate bonds, not junk bonds. However, I think it's overdone at this point in time, and this kind of meshes with my outlook on the market. There's minimal downside, I think, at this point until we get a nice recovery rally. So just like the stock market, I think shorting here, adding new shorts at this level, you got to be careful. If you're very quick, trail down, you might eke out or milk out another 3, 5, even 6, 7, 8% downside in this market. But if you're not careful, you can get caught on the other side of a rally that could take this thing market up 10% or more. So what'll happen is, and I can see it in the charts, see the bullish divergence forming right here? I think the selling in corporate bonds is getting a little bit overdone for the time being, and you can see a wedge type pattern with a divergent low, and so that might be a trading op coming up here, especially for your growth and income investors. I think a pop up here at about that 113.74 level. Remember, you're not going to get rich quick in bonds, but you can use an overweighted position because these are bonds. So whereas you might normally trade 10,000 or 50,000 or whatever your number is into SPY, let's say, you can do double that or more into a bond fund because the volatility and the risk is so low. And that will help then make it worthwhile if you're only shooting for a 2 or 4% gain or so. Okay, quick look. Here's one of the junk bond ETFs. JNK and HYG are the two most popularly traded junk bond ETFs, so I'll use those as a proxy. And just like the stock, junk bonds trade much more in line with stocks than they do bonds. Most other bond classes are more sensitive to changes in interest rates, whereas junk bonds, because they're on that verge of either giving you a payment and paying back your principal or not if things go south. Therefore, they're going to trade more responsive to economic expectations and conditions, so i.e. just like the stock market. Now, just like the stock market, looks to me that the downside right now in junk bonds is minimal. I can see some potential divergence. Looks to me like maybe a scenario, one more thrust down. Again, minimal like the stock market, won't go down as much in percentage terms because they are bonds, and then maybe put in a divergent low and get a nice bounce here to trade into either into year end, maybe into the beginning of the year. Again, it depends when we finally get a pretty good washout move or some signs of a bottom. And maybe maybe we're at that today. Who knows? We'll see. So there's the outlook for junk bonds, corporate bonds, and finally muni bonds. For those of you, muni bonds are typically better for very high net worth individuals with high income because they pay a lower rate. The yield on MUB, this is a national muni bond ETF. I think last I looked, it was about 2.6%. And they've rallied pretty good recently, and you can see there's a nice divergent low. The rally was priced into it, but they've run into resistance. So I would not be chasing these now. And we look at the weekly chart. I want to show you something back here. Let me pause the video. Okay, here it is. This is a post I made back in April of 2016. I called it Muni Bombs. A little pun off the word bond. SNP in the trading room will like that one. So basically, as you can see, what I had said is a break below this uptrend line is likely to bring MUB down to levels which will have wiped out at least a year's worth of interest payments and quite possibly more in the so-called safe haven trade of municipal bonds. So my point being that bonds many consider a safe haven asset, and they're not. There are risks in bonds. Typically you're not going to lose your principal, and you're not going to lose it all in an ETF or a mutual fund that has a lot of investment grade bonds, but you can lose a good part of that. So that was again back in 2016. Let's just go back to the chart we were on. Here's today's chart. This is that same exact trend line, pushed up a little higher, put in a little divergent high there, and boom, there was a sell signal right there. It came, and I did do a follow-up post on that afterwards, and you can see there was a sharp sell-off, and so those bond traders got wiped out and for short order. Again, this drop was only, let me try to measure it in time for you. That was just about 2 months, and in 2 months, muni bonds, which at the time were paying a little bit more, but right now are only paying, or no, they might have been lower than they are now. What I just said, 2.6%, I think, and they dropped 5.6. So exactly what I said. They lost, whoever bought here lost twice what they would have made in interest payments holding for an entire year in just 2 months. And look where they're at. They're back to where they were. They had a little bounce and back to about where they were. So this is not a good investment. We're in a tough environment for bond traders, stock traders, and I've talked about again that quite a bit with the effect that it's going to have on pension funds and other institutional plans like that. There we are. We're at downtrend line resistance on muni bonds. Maybe they break out, but I think they were a little stretched to get here, so I'm favoring a pullback. And again, if you're interested in muni bonds, drop me a line in the trading room, and I'll be glad to mark up a chart. Let's move on and wrap this video up and look at a couple other things I wanted to cover. Next up will be gold. Again, gold, another flight to safety asset. We finally saw treasuries start to kick in as such with the market volatility at first. What I was saying early on in this correction is there were too many non-believers. That's why I was watching gold and treasuries were going down with stocks. The VIX was not going up as much as it would have historically on such a move. The put to call ratios were not at extremes. So, as if you followed me for a while, early on, I said there were just too many non-believers, and as such, there wasn't going to be a bottom in this correction until you get enough believers on board. In other words, bearish sentiment needs to ramp up, and so now we finally started to see gold start to catch a nice flight to safety bid recently. This has been a trade for a while. We went long gold here back in early October at 114.89, right there on the breakout. Quickly hit our first target right here, T1, pulled back, as is often the case. That's why multiple targets are listed. You can actively trade, take profits there, buy back in on a pullback to support. So gold consolidated for a bit, but it's moved up. And the reason I wanted to cover this today, it's now taken out that resistance level. I always set my targets a little bit below the actual resistance level. So this was 117.24 was the actual resistance level. The target was at 117.21. We're popped above it today. However, we still need to take out that previous reaction high. So a little more upside on gold. One thing giving me pause right now is we're starting to build some negative divergences here. So if gold does pop a little more, I'm not sure if it's going to get there, especially if the market starts to stabilize. That might take away this flight to safety bid in gold. As of now, I'm leaving this trade on. There's not enough in the charts to get me to pull this trade in early. Again, it's also part of an asset allocation model. If you're willing to give it some time, I do like the longer term outlook for gold, no matter what happens in the very near term here. And on a related note, GDX, which is also an active trade, we went long back here on September 4th at 1807 right there. Just barely avoided having our stops run with an attempted stop rate. I think the reason is I started wising up. We were having quite a few stops, an unusual amount of trades having the stops just barely run at levels that for years and years I thought were set just below where the stop rates would occur, but I think the algos had wised up to that. Maybe too many people were doing what I was doing. So I started to adjust a lot of the trades and setting the either widening the stops a little bit or setting it on a daily closing basis. And so what happened is we've had several then since then that intraday they would have taken our stops out, but then look at that. And you tell me that's not a stop rate. If you've traded for a while, you know exactly what I'm talking about. You can't see it to the left of the chart. There was a reason that line was there. It's a support level. And that's what we call a stop rate. You see a brief move down and followed by not just prices limping around there, but an explosive move higher. That means they blew out all the longs. The market makers, whoever had enough power to bring the markets down there by selling, forcing the GDX down to that level, they turned around, they went long, and they got in here for the ride. So this is what we call a stop rate. And if you've traded long enough, I'm sure you've had those trades where you had your stop just barely hit, only to see it turn around and go on and play out exactly as you thought. So so far so good on this one, but I wanted to make a few comments to it as well. So we went on to hit the first target and then hit the second target shortly after. When we hit the first target, I did an update and I said I don't expect much of a reaction. I said I expect we'll go on and hit the second target. And at that point, then I expected a reaction. And we got it. We put in a divergent high and then corrected. Had a pretty decent correction. But for the most part, and this is what I wanted to get to, it's been a sideways trade for the gold mining stocks. It's taken gold a while. Gold's traded mostly sideways. So although we are still profitable on this trade, and my final target is still T3 up here at 2169, I went with GDX instead of Nugget on this trade for a particular reason. I didn't see an explosive move up. There are times I'll use Nugget or Dust, but they do not do good. That 3-time leverage works against you in a choppy sideways market. This is exactly when you don't want to own Nugget or Dust if you plan to hold for a long time or think you might get caught in one of these choppy sideways periods. Don't believe me? I'll show you why. Let's look at this real quick. I put the crosshairs here. Here's where we're at today, 1977, right? So let's go back to this point right here. Right up here, and if you look at the crosshairs, that pop-up box is October 11th, about 3 p.m. candle. Now let's go to Nugget. Okay, same 3 p.m. candle right here. Oops, I had it there. Right around. Okay, the crosshairs are at the same level anyways. And as you can see here, so oops, I moved it. We're right here. I tried to grab the 3 p.m. candle. That's October 11th. But you can see now, look at the horizontal line. Nugget is below there. Remember, gold was at the same level today. So we go down, hold that crosshair. That's Nugget has lost 5.15%. That is the leverage, the decay from the 3-time leverage I talk about. It actually works in your favor. If you held Nugget from this point to this point, you would have done not just 3 times better than GDX, you would have done more than 3 times better. Go to the FAQ page if you don't know what I'm talking about under the ETF related questions, and I give an example of how that works. So I just wanted to make that clear if you're trading, because I do see a lot of Dust Nugget things in the trading room. If you can, if you're an active trader and you can game these rips and dips, by all means, but if you can't do that, if you're a swing trader, you're going to be better off holding GDX for the time being until we get some type of setup that indicates we may get a very strong, mostly unidirectional rally. PPLT, this is Platinum, also an official trade, also still active. I have to look. I didn't put the notes where we bought it. We probably bought somewhere in here. We quickly hit our first target here at 80.22. Went on to fall, and this was, sometimes I'm a little too tight or aggressive on the targets. I had a first target at, a second and final target. We would have been out of this trade, closed out flat at 83.40. Some people might have taken full profits there, but if not, we hit a high of 83.11. So we fell just shy of the final target, and it was a pretty significant resistance level, and that's why that was the final target, and have since reversed. So we haven't hit the max stop yet. But although it would have been prudent, I usually say, if you get to that point, you probably should have raised stops to protect profits. But I'll leave the trade on for now. Don't see enough to pull it out. We're close enough to the stop. Just let it see if it works out. And there's really no decay because this is not leveraged. So that's PPLT. Again, just a way to diversify. And on a related note there too, PALL. Palladium has been the big winner of the precious metals. In fact, the Wall Street Journal earlier this week put out an article calling it the Palladium has taken the title or is about to take the title of the most quote unquote precious metal. What I mean by that, or what they mean by that, is gold is considered, a precious metal, and the most precious of the precious metals. You have gold, platinum, palladium. I think those are considered the precious metals. And palladium, for the second time in history, either reached or was about to reach parity on with gold on the price. The price of palladium had come up, closed the gap on gold. It did it once before a few years back, but then boom, you got a mean reversion. Things returned back to the norm where gold went ahead, palladium fell. I think, for what it's worth, palladium's had a heck of a run, but I think that run is probably over. I can see some pretty strong divergences, and while gold has some of those divergences too, I think at this point in time, a paired trade, long gold, short palladium, if you have the capital to do so, would probably work out for you. But either way, I wouldn't chase palladium here at this point. I think it's a little stretched. And finally, sorry I didn't realize this video would go so long. Probably spent a lot of time covering, asset allocation and some of the things in the beginning of the video. But the last of the active long trade ideas is SGG, sugar. This one, so far we're down on it, entered on November 29th right here. And, I'm looking, all commodities are down today. The only thing I see up, I'm looking at another monitor, is cotton, of all things. So again, this is I didn't have the highest convictions on this trade, but I figured it would be good enough. And again, it's a way to have some asset allocation diversification. We're still well above our stop, so we'll give it a little time here. And I do think it'll play out. But at this point in time, I'm not crazy about it, and might offer an objective entry. I'll have to look at the charts of sugar futures for you if you are interested in adding. There is some support right there on SGG. Thinly traded. I've talked about this before. Don't use market orders. You best use a limit order. Split the difference between the bid and the ask when buying and selling, because this ETF, although this has been around a long time, this is a new variation of Barclays Sugar ETN. The old one is being retired, SGGFF, I think it is. So that's why I went with this one. So either way, we'll give it a little room. And if and when I start to see things stabilize, right now, again, we're in that liquidation mode that I talked about in the beginning of the video, where hedge funds, pension funds, individual investors, that bubble has popped. They were loaded to the gills in credit, margin, and it's unwinding, and everything is being sold. So once I do see some bullish developments in the charts of quite a few commodities, but I'm not seeing the bullish price action yet. I'm not seeing signs of a high probability bottom. If that happens, we'll start to add some more of these commodity TNs in. And I'll also tell you, the next trade I'm probably looking at on equities will be on the long side. So like I said, minimal downside in the market, get our ducks in a row, and maybe we'll get a nice swing trade, maybe into year end, maybe after the first of the year, and start really picking up some of these beat down stocks as we get ready for the first what could be a bear market rally. Still can't call it that yet, but call it for what it is. We'll just say a oversold rally, short squeeze, or short cover rally, whatever you want. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.